If you live in an apartment, or hey, maybe you're thinking about investing in one, you're going to want to hear this. That wild post-pandemic boom, it's over. So, what happens next? Today, we're diving deep into what the multifamily housing market is really going to look like heading into 2026.
Okay, so this is the big question, right? The one on everyone's mind. We all saw years of just explosive growth, new buildings popping up literally everywhere. But now, things just feel different. So is the party over for apartment buildings?
And the answer is no. Look, it's not some big collapse. It's more like an evolution. The market is just shifting from one phase to another, and really, understanding that shift is everything. So let's break it all down.
Here's our roadmap for today. First up, we're going to define this new post-boom reality. Then, we'll dig into a fascinating trend, the potential rise of a permanent renter class. After that, we'll pinpoint the hot and cold markets across the country, talk about how to navigate the major headwinds facing the industry. And finally, we'll uncover the strategies smart investors are using to play the long game.
So let's get right into it with that new reality. If you think of the post-pandemic market as a space race, just total unrestrained growth, then 2026 is all about finding a more stable, regulated orbit.
This slide just captures that shift perfectly. We're moving from the chaotic energy of the space race on the left, building as fast as humanly possible, to this more stable, more predictable, regulated orbit on the right. This slowdown in new supply, that's the key change, and trust me, it impacts everything.
But don't mistake moderation for weakness. Just look at this number, 94.5%. That is the national occupancy rate. Let that sink in for a second. Despite all the talk of a cooldown, nearly 95 out of every 100 apartments in the entire country are full. This is not a sign of a collapse. It's the sign of a market with an incredibly strong foundation. The demand is, fundamentally, still there.
So, if the buildings are still full, who is driving all this demand? Where is it coming from? Let's jump into our next section and see what's going on. We're looking at some really powerful economic and demographic forces that might just be creating a permanent renter class. This quote from the National Association of Realtors really just hits the nail on the head. For a ton of people, buying a home is getting harder and harder. There aren't enough houses to go around, mortgage rates are high, and saving up for that down payment is a massive hurdle. The key takeaway here is simple. People are renting for longer. And this number is it's stunning. For the first time in history, the average age of a first-time homebuyer has hit 40. 40! Think about that for a second. That dream of owning a home in your 20s or 30s, it's quickly becoming the exception, not the rule. This isn't some small statistical blip, it's a huge generational shift in how we live. And to add to that, first-time buyers now make up just 21% of the housing market, which is a historically low number. This 1-2 punch of data shows it plain as day. The traditional path to owning a home is being delayed or completely rerouted for millions of people, and that keeps them in the rental market.
And it's not just young professionals anymore. The demand is getting broader. We're seeing way more young families who want that house with a backyard but just can't afford to buy, so they're looking for single-family rentals. And then on the other end of the spectrum, you have retirees selling their big family homes and downsizing into convenient rental properties.
Now, that stable national picture we painted a minute ago, well, it's kind of hiding some really dramatic regional differences. It's honestly a tale of two markets out there, with some cities still booming while others are cooling off in a big way. And it all comes down to supply and demand.
This chart tells the big story on the supply side. That massive wave of construction we've seen, it's finally cresting. We're expecting about 450,000 new apartments in 2026, which, yeah, it sounds like a lot, but it's actually a 24% drop from the year before. This slowdown is going to rebalance the market over the next few years.
And this is where it gets really local. So in high-supply markets like Houston, there are so many new buildings that landlords are actually struggling to fill them, which means absorption rates are falling. But then you look at low-supply markets like Chicago, there just aren't enough apartments to meet demand, so occupancy stays high and, you guessed it, rents keep on growing.
Okay, so of course, it's not all smooth sailing. The industry is facing some very real challenges, or headwinds, that can impact everything from profitability to whether new buildings get built at all.
In a market where rent growth is slowing down, landlords are having to change their whole strategy. It's not just about landing new tenants at the highest price anymore. The focus is shifting to something called blended rent growth. All that means is balancing the rent you get from new leases with the rent from your existing tenants who decide to renew.
keeping your good tenants happy is now just as important as finding new ones. It's a huge shift towards stability and retention.
The job market is what a lot of experts are calling a flashing yellow light. Right now, things seem stable, with unemployment hanging around 4.3%. But here's the thing. The multifamily market doesn't just need jobs to survive, it needs job growth to thrive. If the job market starts to cool off, apartment demand is going to cool right along with it.
Another significant headwind is regulation. With housing affordability being such a major issue, there are over 100 rent control bills being kicked around nationwide. Now, you have groups like the National Apartment Association, quoted here, who argue that these policies, which they call failed, ultimately just shrink the housing supply by discouraging new construction. On the other side, advocates argue these laws provide crucial stability for renters. It's a major political battle with huge financial implications for everyone involved.
So, with all this change and uncertainty, how are investors looking at the market? Well, they're playing the long game. They're actually looking for opportunities being created by this very cooldown.
Austin, Texas is the perfect case study here. It went through this massive boom, then got absolutely flooded with so much new supply that rents just flattened out completely. But now that oversupply is starting to get absorbed and rent growth is coming back. Investors are watching Austin as a bellwether, a sign of what might happen next in other oversupplied cities like Phoenix and Nashville. And this right here, this is the core investment thesis. Even with a potentially weak year in 2026, the fundamental drivers of demand, the difficulty of homeownership, the demographic shifts, they are so strong that investors still see multifamily apartments as the most resilient, consistent, and attractive long-term bet in all of real estate. So we'll leave you with this final thought. All the data suggests that renting is no longer just a temporary stop for millions of Americans, it's becoming a long-term reality. And that forces us to ask a much bigger question. As this trend continues, how does it reshape our very definition of the American dream?